Welcome to the deep dive. We're here to crack open complex documents, pull out the key insights, just for you. Today we are plunging into the strategic blueprint of a real tech giant, Texas Instruments. We've got our hands on their 2024 Form 10K annual report. And this isn't just a stack of financial tables, it's really a detailed look under the hood. It shows how a major player in the semiconductor world operates, adapts, and plans, well, decades ahead, really.
That's exactly right. Our mission today is to, well, truly unpack what Texas Instruments, or TI as we'll probably call them, is all about. We'll explore their core business segments, their pretty ambitious long-term growth strategy, and also the significant challenges they navigated in 2024. Then, yeah, we'll dive into the critical financial numbers, try to understand the why behind their performance, and see how they plan to create, enduring value for their owners. What's really fascinating, I think, is how a company with such a long history keeps innovating and positioning itself, even in a market that's notoriously cyclical.
So whether you're prepping for a big meeting, maybe just curious about the tech that powers pretty much everything, or looking for those aha moments about smart business strategy, you are absolutely in the right place. Let's get started. Okay, so TI's president and CEO, Haviv Alan, stated their ultimate objective is, and I quote, the growth of free cash flow per share over the long term. It's a very specific, powerful guiding principle. How do they actually do that? How does their core business model make that happen?
Well, fundamentally, TI designs and manufactures semiconductors. Think of them as the basic electronic building blocks inside, well, almost every modern electronic system. You can imagine your car, your phone, even your smart toaster. They operate mainly through two big segments, analog and embedded processing. And there's a smaller other segment too. Now, the analog segment, that's really their powerhouse. In 2024, it generated something like 78% of TI's total revenue. Analog chips are all about interacting with the real world. They manage signals, sound, temperature, pressure, images, you name it. They convert them, amplify them, or manage power efficiently inside electronics. Within analog, you find lines like PowerThink battery management, voltage regulators, and signal chain, which is amplifiers, data converters, motor drives. Kind of the unsung heroes making electronics work smoothly.
Okay, so analog bridges the physical and digital. Then for the actual processing, the digital side, where do TI's chips fit? What about embedded processing?
Good question. The embedded processing segment brought in about $2.53 billion in revenue in 2024, so roughly 16% of the total. These are basically the digital brains in electronics. They're designed for specific tasks, optimized for things like performance, power use, cost, depending on what's needed. And what's really key here for TI is customer loyalty, or maybe stickiness is a better word.
Stickiness. How so?
Well, customers often invest a lot of their own R&D writing software specifically for TI's embedded chips. Once they've built their system around a TI chip and invested all that time and money in the software, switching to a competitor means redoing a huge chunk of work. So they're much more likely to stick with TI for the next generation of their product. It creates these really strong long-term relationships.
Okay. That built-in loyalty, that sounds like a significant competitive advantage. And then there's the smaller other segment you mentioned.
Yes, the other segment, it covers the rest, basically. Things like their DLP products used mostly for high-def image projection, think projectors plus calculators, and custom ASICs, application-specific integrated circuits. Chips designed for one very specific job, making them super efficient for that task. That whole other segment brought in about $947 million in revenue in 2024.
Got it. So their products are kind of everywhere, but it sounds like they have a very clear strategic focus on particular markets. Can you tell us about that?
Absolutely. Yeah, while they serve a ton of different markets, they put, as they say, additional strategic emphasis on industrial and automotive. Those two markets together made up about 70% of their revenue in 2024. Industrial automation was 34%, and automotive things like infotainment, dashboards, and ADS, driver assistance systems, that was 35%.
70% just from those two. Wow.
Yeah, and they believe these areas can grow faster than the overall semiconductor market. They talk about secular content growth.
Secular content growth, meaning?
It basically just means the amount of semiconductor technology going into these products is increasing steadily over time, kind of independent of short-term economic ups and downs. So more chips are going into every new car, every new factory machine.
Right. Okay. That makes sense. So given all that, What are the core competitive advantages that really set TI apart? It's a super crowded space.
It is, and TI's strategy is built on four very clear, sustainable competitive advantages. First, a strong foundation in manufacturing and technology. They own their own manufacturing, their own process tech, their own packaging. This gives them lower costs and much greater control over their supply chain. And crucially, it offers customers what TI calls geopolitically dependable supply, which is a huge deal these days.
And that ties into the wafer size thing, right?
Exactly. A key detail here. An unpackaged chip made on a 300mm wafer costs about 40% less than one made on an older 200mm wafer.
40% less? That's massive.
It really is. Think of it like using a bigger baking sheet. You get way more cookies, or chips in this case, from each batch, so the cost per cookie per chip goes way down.
Okay, that 40% cost edge on 300mm wafers is a huge differentiator. So how are they actually leveraging that? What are they doing now?
Well, that leads right into their next big push. They are deep into what they call a 6-year elevated CapEx cycle. They're about 70% through it.
Elevated CapEx cycle. So basically spending a lot on new factories and equipment.
Precisely. A massive multi-year spending program. They're hugely expanding their internal 300mm wafer fab capacity. They're ramping up production at RFAB2 in Texas, LFAB1 in Utah, and they're getting SM1 and SM2 ready in Sherman, Texas, plus another one, LFAB2 in Lehigh. The goal here is ambitious. Source more than 95% of their wafers internally, with over 80% of that on the cost-effective 300mm wafers, all by 2030.
Wow, 95% internal. That's a huge bet on controlling their own manufacturing control.
It's a monumental investment. It's all about locking in that long-term, low-cost capacity and really solidifying their supply chain control.
Okay, so building up that manufacturing is a massive play. What are the other advantages? You said 4.
Right. Third is their incredibly broad portfolio of products. They have over 80,000 different products.
80,000.
Yep. Which means, as they put it, more opportunity per customer and more value for their investments because they can solve so many different problems for a single customer. Fourth is the reach of their market channels. They sell to over 100,000 customers worldwide. And interestingly, in 2024, about 80% of their revenue was direct sales, including through TI.com.
So cutting out middlemen.
Largely, yeah. That direct model strengthens relationships, gives them better insight into what customers actually need. And finally, the fifth advantage is the diversity and longevity of their products, markets, and customers. This wide base means they aren't too dependent on any single market or customer, which gives them resilience.
Okay, let's pivot to the numbers then. How did this strategy, especially with all those big investments, translate into performance in 2024, particularly since they called it a weaker overall semiconductor market environment?
Yeah, 2024 was definitely tough on the top line. Total revenue came in at $15.64 billion.
Which was down from
$17.51 billion in 2023 and $20.02 billion back in 2022. So that 10.7% revenue drop in 2024, TI noted, was actually below median compared to their peers.
below median, so others did better on revenue.
Some did, yeah.
Yeah.
But TI points out their growth is purely organic internal innovation expansion. A lot of peers use acquisitions to boost their revenue numbers, which TI doesn't really do.
Right. So organic growth was down. How did that hit profitability, especially with all those fixed manufacturing costs you mentioned?
Good point. Their gross profit was $9.094 billion in 2024, down from over $11 billion the year before. Operating profit landed at $5.465 billion. That gives an operating profit margin of 34.9% for 2024.
34.9%. How does that stack up?
Interestingly, that margin was considered above median compared to their peers, which is pretty notable in a down market year. But TI does highlight, because they own so much manufacturing, a big chunk of their operating costs are fixed. So when demand drops and factories aren't running full tilt, those fixed costs get spread over fewer units, which does squeeze margins.
Makes sense. So despite those market headwinds, what about investments? Did they pull back on R&D or that big CapEx spending?
Quite the opposite, actually. They kept R&D steady, spending just under $2 billion, $1.959 billion in 2024.
So still investing in innovation even when sales are soft.
Exactly. Shows that long-term focus. Selling, general, and admin expenses were about $1.8 billion. And crucially, capital expenditures, the CapEx, stayed high at $4.82 billion in 2024.
Still pouring money into those fabs.
Yep, mostly for semiconductor manufacturing gear and buildings. It really reflects that ongoing elevated CapEx cycle we talked about. They're sticking to the plan.
Okay, so investing heavily even in a downturn. How did all that impact their cash flow? Was cash getting tight?
Remarkably, no. Their cash flow from operations was still very strong at $6.32 billion in 2024.
Still over $6 billion, even with lower profit.
Yeah, it was down slightly from $6.42 billion in 2023 because of the lower net income, but that was partly offset because they used less cash for working capital. TI specifically said this strong cash flow underscored the strength of their business model and 300mm production benefit. Now, looking at free cash flow, which isn't a standard accounting metric, it's non-GAAP, but it's the one they really emphasize.
Right, the ultimate measure to generate value.
Exactly. That was $1.50 billion in 2024, and interestingly, that was actually up from $1.349 billion in 2023. It represented about 9.6% of revenue.
Up. How did free cash flow go up when revenue and operating cash were slightly down?
Well, remember, free cash flow is cash from operations minus capital expenditures.
Yeah.
While CapEx was high, the operational cash flow held up well, and maybe some other factors like working capital helped nudge it slightly higher year over year, despite the massive CapEx spend continuing.
Okay, got it. Now, this is where things get really interesting, I think. The government support the CHIPS Act. How did that factor in during 2024?
Oh, hugely. In 2024, TI got a $588 million cash benefit directly from the U.S. CHIPS and Science Act Investment Tax Credit, the ITC.
$588 million. Just like that.
Well, it directly reduced the income taxes they had to pay, so yes, a very substantial cash benefit.
Yeah.
And looking forward, this is even bigger. They expect to get somewhere between $7.5 billion and $9.5 billion total through 2034 from the CHIPS Act.
Wow, billions. What form does that take?
It includes more of those investment tax credits for qualified U.S. manufacturing investments, plus direct funding up to $1.6 billion for those big 300mm fabs they're building in Sherman, Texas, and Lehi, Utah.
Yeah.
It really shows how significant government policy can be for a company's investment plans and overall financials in a strategic industry like semiconductors.
Absolutely. So TI often talks about thinking like owners for the long term. Beyond the operations and financials, how do they actually return value directly to those owners, to the shareholders?
Their commitment is crystal clear on this. They aim to return all free cash flow to our owners over time, primarily through two ways. First, dividends. They raised the dividend by 5% in 2024. That's something they do pretty consistently. They say dividends are designed to appeal to a broad set of investors.
Okay, consistent dividends. And the second way?
Second is share buybacks. They repurchase their own shares with the stated goal of accretive capture of future free cash flow for long-term investors.
Accretive capture. Can you unpack that a bit?
Yeah, basically, by buying back its own stock, TI reduces the total number of shares out there on the market. So when the company generates strong free cash flow down the road, that cash flow gets divided among fewer shares. Each remaining share represents a slightly bigger slice of the pie.
So it boosts that free cash flow per share number they focus on.
Exactly. It's a direct way to enhance that key metric. And they have plenty of room to do it. As of the end of 2024, TI had over $20.26 billion remaining under their existing buyback authorizations, with no expiration date. And looking back over the decade from 2015 to 2024, they consistently used capital for both dividends and buybacks. It really shows that disciplined approach to returning cash.
Okay, so connecting all these threads, the focus on manufacturing, the specific financial goals, the returns, what's the big picture view here? How does TI really define creating value?
I think the core belief, the thread connecting everything, is that long-term growth of free cash flow per share is the ultimate goal. It's the North Star. This philosophy guides all their decisions, operations, investments, like those huge CapEx spends on manufacturing. It aligns everything directly with shareholder returns. It's clearly not just about hitting next quarter's profit target. It's about building a company that's durable, efficient, well-positioned for decades, and consistently returns capital to its owners.
Right. So looking ahead then, how is TI positioned, and what are the big hurdles, the critical challenges they're facing in this ever-changing world, as they put it?
Well, the focus remains on strengthening those competitive advantages we talked about, maintaining that disciplined capital allocation, and just relentlessly hunting for efficiencies. But the 10K is also very clear about the risks. The biggest, perhaps most inherent one, is the semiconductor market cycle.
The boom and bust cycles.
Exactly. It's historically defined by this ebb and flow of supply and demand, building up inventory, then working it off. It leads to these pretty pronounced upturns and downturns. And TI's strategy here is actually quite interesting, maybe a bit contrarian. They aim to build ahead of demand for their broad-based products.
Build ahead of demand. So make chips even when sales are slow. That sounds risky. Ties up capital, right?
It does tie up capital, absolutely. It's a calculated risk. But
Yeah.
the idea is to be ready for the next upcycle, to have products on the shelf when demand suddenly surges so they can maintain high customer service levels.
Okay, so it's a bet that being ready for the upswing outweighs the cost of holding inventory during the downswing. What about competition?
Oh, it's fierce. The analog and embedded markets are highly fragmented. You've got dozens of competitors, big and small, globally, and especially emerging companies in Asia. TI faces, quote, intense technological and pricing competition. And there are specific geopolitical risks tied to this, like China actively promoting its own domestic semiconductor industry that could potentially limit TI's access or competitiveness in that huge market.
Yeah, and speaking of geopolitics, their global footprint must create other challenges too.
Definitely. They operate in over 30 countries. About 60% of their revenue comes from customers outside the US and 20% just from customers headquartered in China.
20% from China alone.
Yeah, so they're highly exposed to geopolitical tensions, tariffs, trade fights, general macroeconomic conditions worldwide. And operationally, there are always supply chain and manufacturing risks. Reliance on outside suppliers for some things, potential disruptions, think natural disasters, health crises, cyber attacks, or just not getting key materials. Plus, executing those complex new manufacturing rollouts on time and getting the right people is critical.
And the pace of technology itself must be relentless.
Absolutely. Rapid technological change means product life cycles get shorter, average selling prices tend to fall over time. That requires constant, significant R&D spending just to keep up, let alone get ahead. And underpinning everything, really, is talent. As they state, their continued success depends in part on our ability to retain, train, and recruit a sufficient number of qualified employees. It's a competitive environment for engineers, manufacturing experts, salespeople.
Do they give any numbers on that, like turnover?
They do. In 2024, their turnover rate was 9.1%. That's out of about 34,000 employees globally. And critically, 90% of their workforce is in those key R&D, sales, or manufacturing roles. So retaining that 90% is vital.
It really does sound like a constant juggling act. You've got these massive, decade-long investment plans on one hand, and then navigating immediate market drops, global politics, competition on the other. What stands out most to you about how TI is managing all this?
You know, it's that deep commitment to internal manufacturing and the unwavering focus on free cash flow per share growth, even when the market's down. It's a fascinating display of long-term strategic conviction. It feels like they're saying, look, we're going to build our own really sturdy ship, even if it costs a lot up front, because we believe that's the best way to navigate these stormy seas and ultimately control our own course. But it does raise that fundamental question, doesn't it? In an industry this volatile, this prone to cycles and global shocks, how much can one company really insulate itself and control its destiny just through sheer focused investment? And how much is just about being incredibly adaptable?
That's a great point. We've really journeyed through the strategic mind of Texas Instruments today, from their core analog and embedded businesses, through those huge manufacturing bets, to their very disciplined financial approach. As you reflect on this deep dive, maybe consider how TI's balancing act, that tension between long-term vision and immediate market chaos, might resonate with challenges in your own world, whatever that might be. Does doubling down on your core capabilities, investing heavily even when things look uncertain, truly insulate you from the shocks? Or does it mainly just prepare you to come out stronger on the other side? Something for you to think about until our next deep dive.